So oil prices have tumbled the last week following the initial collapse of Silicon Valley Bank and fears of economic slowdown. What do you think about the current pricing? Is it justifiable?
Well, last week was really tough on the oil market. I mean, everything fell, but oil and oil field service companies and oil producers fell even more. And that is because the picture is fundamentally oversupplied right now in the first quarter. The first shock we had come out for some of the market is that Russian oil continues to flow. Without a problem, we expect it to be flat production for the entirety of this year. And the IEA still keeps pushing that, kicking the can along the road and saying that, okay, in Q2, we're going to lose 800,000 barrels per day of Russian supply. OPEC thinks we're going to lose 900,000 barrels per day of Russian supply. And that's just simply not the case. And why is that? It is because there is too much demand for oil in China, because of this reopening in India and in the rest of non-OECD Asia, countries like Vietnam and so forth. McKinsey's come out saying there's no more supply chain bottleneck in Asia. So it has enormous consequences on the demand side. But having said that, right now we are still oversupplied by oil, and China is buying 1 million barrels per day less oil now than they were in Q4. So that picture will change, especially by the third quarter of the year, where we see stocks drawing by almost 1 million barrels per day. But for right now, we're oversupplied, and that is why the oil price has come down as far as it has.
Mm. Yeah. And what will the situation look like in Europe then, doing this transition to renewable energy, and what will the challenges look like?
So right now we have this volatility in the oil market. We've had extreme volatility in the gas market, right? And when we think about energy transition, it's really about the power market, right? And power prices are set by that last marginal provider of energy. And last year, that had to be the gas price. And why is that? Nuclear power was down more than 50% in France. We had a lack of hydropower in Norway. So we couldn't, Norway was the 6th largest power exporter. Sweden was actually number 1. You know, we had this resumption of coal use. Italy, for example, resumed coal operations 50% higher year on year. It was only 30 terawatt hours, but still, that's a completely wrong directional shift. And it's because there was a lack of wind and there was a lack of hydro, right? And so this is where we are so dependent on oil and gas in terms of having that stack model of power provision, right? So we now have things moving back from coal into gas, which is generally more positive. But as we get that renewable stack increasing as a percentage, we're going to have even more variability and volatility. So we need to have more gas coming into Europe. That's why we're building out LNG infrastructure, regasification capacity. And that's why we are also using oil. Germany, we know 35 companies that bought big backup diesel generators for their systems so they can keep running last year during this crisis. Oil is the easiest commodity in terms of that energy stack to get it from point A to B, and that is why we've been so reliable on it. So the unfortunate truth of the matter is, even though we want to do this energy transition and we are investing in renewables, we need oil and gas investments to be a part of that transition to make it a just transition. You know, this gas crisis last year put so many people below the energy poverty line again last year. Something we haven't seen when we think of the UN development goals in the last decade, you know, in countries like Bangladesh, in the Philippines, and so forth, because they can't afford to buy natural gas at the prices that we're importing LNG. So this is where we have to invest in all three of those things together. So a strong oil price in the second half of this year, above $90 a barrel, will bring more investment into the oil space, into the gas space, and it will also allow that renewables transition to happen, and we'll have higher higher power prices, but that will accelerate the energy transition because you will get more of a return on investment in power, in renewables in Europe.
Okay, well, it does sound kind of positive still, so, but is there a time frame, sort of, how long do you think that it will take to get this into place?
And well, I mean, every year we're increasing the renewables energy spot, right? But what we have to understand is just because we are transitioning and we hit peak oil demand in 2030, probably in Pareto's perspective, 2036 for natural gas peak demand. You know, what we learned in COVID, at the worst time, we only lost 10% of demand in oil. So it's not going to be this collapse in trajectory on oil demand. It will continue to still be a part of the mix, but it will finally stop growing, right? And so that is good. You know, this is why the transition has to include things like carbon capture, has to include the most reliable, cleanest oil in the world, not high sulfur oil, not polluting production in oil. You know, I'm actually a Canadian citizen. Oil sands, you know, that's the worst kind of oil in the world, relatively speaking, although we need some to create asphalt and roads, right? So we still need some, but it is about changing that mix. And when we look at China, for example, they're the #1 investor in renewables, right? They're miles ahead of everybody else because they're focused on energy security. They're also the #1 oil importer in the world, #1 gas. Putin and Xi are meeting now. They're going to build more pipelines from Russia to China. So from 2030 to 2035, we expect all of this gas that used to go from Russia to Europe to go to China. And I think the market is not really aware of that transition. In the meantime, we need more natural gas to come from the US here so that we can have a balanced market without blackouts. But we can, you know, we can hit a great spot by 2030, 2045, 2050, and so forth. You know, on EV vehicles, we're at a 1.5 degree scenario already for sure. That might improve even more. Maybe on trucks, we'll end up at a 1.8 degree scenario. But on natural gas, we're at a 2.0. And that is where, you know, we have to clean up our gas power plants in Europe so that we don't have leakages, things like that. But it's tough to invest in that in this environment right now, you know, when everyone would rather just do renewables and forget about gas, but we can't forget about it.
But if just going back to the pricing a bit, you mentioned that you see oil prices going back to $90 a barrel. Are there any other risk factors to take into account? Is there anything that could happen that could lead to an increased drop in prices instead?
Yeah, in the short term, in the second quarter, the market looks very sloppy. It's, you know, we have a US SPR, Strategic Petroleum Reserves, are being released 300,000 barrels per day. And we don't see that huge demand pickup as high in Q2 as in Q3. So there's absolutely a risk that prices will come down lower. I think OPEC, they have a meeting on April 3rd. They will take this into account. I think with the way things are stacked right now, they would rather be proactive and do a small cut for the second quarter to stop prices from collapsing further. It's not to prop up the oil price to $90 a barrel. Demand is the only thing that will do that, and that is going to come from Asia.
And what's your price outlook in the next coming years?
So for next year, for example, we maintain $100 a barrel because that is what you need to invest sufficiently in the oil market and in supply, because the US shale story on growth is not what it used to be. You know, in 2014, it was like a tech stock, growth stock. It was all about, okay, increased production, nobody cares about margin. Now it's a much more mature market. It's tougher to grow production as efficiently as before. You have a lot of inflationary costs and so forth, and you can only dig wells so laterally long before you hit your neighbor's patch, right? So that is where we're not going to have that growth going forward. And we see that investors want a buffer between the oil price and the break-even cost of a project. So $60 to $65 investments can be made, but we now see in shale in the US, for example, break-even prices for gassier plays, meaning where you have gas, associated gas as well as oil, they have a break-even oil price of $100 a barrel. And you can't just pollute that into the air, that excess gas, under the Biden administration like you could under the Trump administration. So that is where there's a lot more pressure. Our long-term oil price forecast is still $70 a barrel, but we will overshoot that multiple times in the next decade.
Okay, so a lot of volatility ahead.
Yeah, but it's going to be a stronger upcycle. That is where we are in the market now.